My name is Nancy Roberts, and I'm an economics professor at Arizona State University. And today we're going to talk about taxes. In fact, excise taxes in particular, but I just want to introduce taxes in general. The government imposes taxes for two reasons, really. One is to generate revenue, because there are things the government does that they build roads, they provide national defense, they provide education, and these things cost money, and therefore the government has to generate revenue to do these things. Another reason why the government taxes certain goods is because they want us to not use them as much. For example, cigarettes. We have very high taxes on cigarettes, and the government is, in essence, trying to get us to decrease our consumption of cigarettes. So what I want to talk about are taxes in general, and there are a lot of bases upon which taxes are imposed. Taxes are imposed on income. That's the one we're probably most familiar with, an income tax. April 15th, every year we have to do our income taxes. Government also imposes taxes on property. So if you own a home and some land, the government will impose a tax every year on the value of your property. Government also imposes taxes on consumption. So if you buy this pen, there'll be a tax imposed on it. Government also imposes taxes on interest. So if you have some money and you put it away and it generates interest, you'll be taxed on that because it's considered income. It's interest income, but you get taxed on that. You get taxed on wealth, and you also, companies get taxed on their profits, and also, when you die, you get taxed. It's called, I call it the death tax. So what I want to do today, we're not going to look at all of these. I'll probably spend some time talking about income taxes at another time. But today I'm going to talk about a tax on consumption, and in particular, I'm going to talk about an excise tax. So we could tax consumption either using an excise tax or an ad valorem tax. An ad valorem tax is a percentage. So if this costs $1, an ad valorem tax would say you're going to pay 7% of whatever this marker cost. If you spend $10 on something, an ad valorem tax would say you're going to pay 7% of that $10 value. So an ad valorem tax changes based on the value. An excise tax is set. It's a per unit tax, like $1 on a package of cigarettes, or $5 on a package of cigarettes, whatever the excise tax is. Estate tax, that's what this is called. It's called the estate tax. So when you die, if you have an estate, we're going to tax it. It's a bad day already, but it's not over. Okay. So let's see how an excise tax works, and who pays the tax, and how that burden is shared between consumer and producer, and the deadweight loss that's created. So if we have the demand and supply for anything, the equilibrium is Q star and P star, and you can see consumer surplus and producer surplus. So consumer surplus and producer surplus is wealth in this economy. We've defined producer and consumer surplus earlier in the semester. If the government, and it doesn't matter what their reason is, if their reason is we just want to generate some revenue, okay, or if their reason is we don't want you consuming as much of this, it's not good for you, so we're going to tax it, It doesn't matter what the reason is. The result is the same. And furthermore, it doesn't matter if the government says we're going to collect the tax from the producer, or if the government says we're going to collect the tax from the consumer. Either way, the result is exactly the same. So, I mean, we tax gasoline. Let's say 50 cents a gallon is the tax on gasoline. We could say we're going to collect all this tax from Mobil, the store that sells the gasoline, or we could say, no, we're going to collect the 50 cents per gallon tax from the consumer. It doesn't matter because the result's going to be the same. The deadweight loss is the same. The share of the tax burden is the same. Either way. It's typical to collect the tax from the producer. It's more efficient. So let's just tax this product. Here's my supply curve with the tax. So this is no longer my equilibrium. This is my new equilibrium because the government has said every time you sell one of these things, whatever it is, you, the supplier of this product, have to give me this much money. Here's the tax. If it's $1, if it's 50 cents, whatever it is. Okay, well, E2 is my new equilibrium. My price goes up to P2. And the quantity consumed goes down to Q2. And again, the consumer pays this new price, P2. But the producer doesn't get to keep P2 because the producer is responsible for paying the government the tax revenue. The producer only gets to keep, let's call it P0. So the consumer pays a price of P2, and Q2 of these are bought, but all of this is my government revenue. P2 minus P0 times Q2 units. So all of this is government revenue that's collected from this tax. We need to investigate this further, and that is to look at how much of this tax is passed on to the consumer and how much of this tax is borne by the producer, because they share this tax. People incorrectly assume that a tax is always going to be passed completely on to the consumer. You're going to tax the producer, it doesn't matter, they're going to pass it all on to the consumer. They're not. It's not true. And in fact, we can see it here. The consumer used to pay P star before we imposed the tax. The consumer paid a price of P star. Now the consumer pays a price of P2. But the increase from P star to P2 is not the amount of the tax. Here's the amount of the tax. So the consumer's share is this area right here. That's the consumer's share of this tax. But the whole tax revenue is all of this. So this bit down here, the producer used to collect P star. Now the producer only gets to keep P0. So this is the producer's share of that tax burden. And all of this is the tax burden. And it's shared by producer and consumer. What we want to look at in addition to the consumer and producer share of this is this deadweight loss, this welfare loss. Because here's the benefits to individuals, to consumers from this good. That's what my demand curve is. Here's the cost. Every unit between Q2 and Q star has a benefit greater than a cost, but we're not going to get any of those units because of this tax. So this is my dead weight loss from this tax. You see, all of this used to be wealth in the economy. We have introduced a third agent. Originally, we just had a buyer and a seller. Now we have a buyer, a seller, and the government. The government's part of our economy, and what we've done is we've taken some wealth away from consumers and given it to the government. We've taken some wealth away from producers and given it to the government. What we haven't done is given any of this to anybody in our economy. This used to be part of consumer and producer surplus that's now gone. It's wealth that's been taken out of the economy. And so the interesting thing about this is, for tax policy purposes, the government is actually looking to minimize the deadweight loss. Okay, so the government needs revenue. We have to build roads. We have to have defense. And so the government needs revenue. But the question is, how can we tax such that this deadweight loss is as small as possible? And in fact, economists have a lot to say about this. And what economists have to say is, the more inelastic the demand, the smaller the deadweight loss. The more inelastic the supply, the smaller the deadweight loss. So the key here is, if you're trying to minimize deadweight loss, yet you want to collect revenue, that you tax things that have either an inelastic demand or an inelastic supply. And when we think about the things that we impose excise taxes on, cigarettes, that has a pretty inelastic demand. Gasoline, that has a pretty inelastic demand. Alcohol, that has a pretty inelastic demand. When we think about excise taxes, those are things with excise taxes on them. So the idea is that we are generating this revenue that we want. I mean, again, you can argue about whether or not the government does silly things with the revenue, but to generate the revenue, it's much more efficient to generate it using an excise tax off of goods with an inelastic demand or supply.